We live in a connected economy, a global economy now. We're not in a silo. So let's talk about the Russian exposure. First, let's talk about exposure in investing. Exposure is just a word for when you have an allocation of your portfolio dedicated to a certain criteria in investing. It could be a sector like tech or energy, could be a specific company like Tesla or Apple, could be a country like Russia, for example, or Peru. So it just really, exposure just means that you have a certain allocation towards something. Now we're seeing in the news lately, big funds. One of the biggest funds in the US is the California Public Workers Retirement and Teachers Retirement Accounts. And we're seeing that they have exposure to Russian investment. And so does a company like UBS and Goldman. And, so it's like, how does this happen, right? How does this happen? How does this happen to the everyday person as well? Well, when you work, you have a 401k. If you're out of work, you might have an IRA, or, again, if you're working, you might have an annuity. These types of retirement accounts are traded, right? There's a financial company or a bank that is in custodian of the accounts and takes care of them and invests them for you. Now, based on your investment profile, your risk profile, you might be somewhere medium to aggressive in your investment. That means that your portfolio manager or your money manager might invest in an emerging market or a frontier market. Why? These are not developed markets like the US and Japan. These are emerging and frontier. Typically, not always, but typically there can be larger yields and larger returns from investing in these type of markets, right? So in America, the lowest type of, not the lowest, but one of the lower yields is always going to be something backed by the government because it's not as risky. If you go after a corporate bond, right, or a corporate investment with debt, it's going to be riskier. But because of that risk, if it pays off, you're rewarded with a higher yield, a higher interest rate. It's the same thing. So what happens is these companies go out and they invest in, some type of Russian assets. We live in a connected economy, a global economy now. We're not in a silo. So you will see exposure to foreign countries. And these investments come in the form of, it could be debt, like a bond. So you could have your investments in, Russian corporations that are, being issued debt, and then you can invest in that debt as a form of a bond. You can have ETFs. ETFs are exchange-traded funds, and these exchange-traded funds will track a pool of investments, like stocks, of companies in Russia. Could be directly government bonds. You could be directly purchasing or investing in bonds from the Russian government. So there's different ways to do that, different risk factors. Obviously, if it's stocks or ETFs, you're a little bit more liquid, meaning you can get your money out of there a little bit easier. If it's something like a corporate bond or a government bond, and you have something like a war happening, it might be a little bit more difficult to get that capital out of there and sell that bond or find a buyer on the market for something like that. So obviously, investing in frontier and emerging markets always comes with risk, but people balance that risk with a higher yield, a higher return. But in a case like what we're seeing happening now, you see where that risk really comes into play. And now, Russian ETF, I saw a Russian ETF that I was tracking. I mean, it went from over $41 a share down to $8. You've seen, certain bonds in Russia are now rated as junk bonds. So you see the impact that this can have. But again, this is how this type of thing happens.